Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for April 2nd, 2023. Got a huge video for you today. There's a lot I really want to talk about because I actually even have individual stocks that I want to talk about. The end of month, end of quarter flows. We got a huge week this next week with jobs reports, but it's also a holiday week where we're going to have Good Friday, lack of liquidity, an NFP. It's going to be crazy mayhem. I'm going to talk about currencies. I'm going to talk about indexes. I'm going to talk about precious metals, where they're at, and some anecdotal evidence and things that we need to actually start taking a look at that's really got me concerned about the markets. But before we get into all that, I just want to say, if you want to try out Forex Analytics, you can try it for $1 for 10 days. You can do that. That's an easy way to do it. But you can also check out the Trader Funding Program, because if you want to learn how to risk our money, you don't want to risk your own money, and you want to keep 75% of the returns and take none of the risk. We take all the risk. Check out the Trader Funding Program. If you just don't have the ability to trade $1 million account, or you don't have the money, or you just don't want to risk your own money, you can go from a $25,000 account to $1 million account. Take an assessment, see if you can trade our money. You have to pass the assessment. It's in a demo environment. You have unlimited time, and you're included in the Forex Analytics community. Because when you're in the community, not only do you get this awesome platform that you'll see right here, with the live squawk feed, with all the analysis of 30 different instruments, with the data flash, internal news flows, you get all of that included, but you also get inside one of the most active chat rooms in the markets. It's the Forex Analytics community, because we want you trading with us. Have some ideas, talk to different traders, not just staff members, but talk to different traders, see what they're doing, what they're buying, what they're selling, because we don't want to leave you out there alone. So make sure you check out the Trader Funding Program. Link is down below. Also, Forex Analytics link is down below as well. All right, I'm going to jump into the actual charts, because I'm going to take us to what we were discussing last week. Like I said, I have so much to talk about today. Let's start off with the currency market. And I'm going to say that last week was not my best showing as a trader. It was the end of month, end of quarter flows. And my colleague, Kay, he also, reminded us it was the end of fiscal year flows for Japan. And we saw like one-way price action all the way up until Friday's PCE data. And the PCE data actually moved the markets opposite. You saw a little profit taking, you saw a little bit of a reversal once all of those flows got done. But you'll notice that the euro actually rallied right to resistance. And these are the charts that we talked about last week. We rallied right into resistance, which suggests that we are trying to carve out a lower high in the euro. Now, you might be looking at the euro saying, well, Blake, it's going to go to 110. Okay. But what we have to do is really break out first. So until we start breaking out, we might actually be building a long-term consolidation in the euro. So just take that into consideration, and also thinking about where we're at as far as risk goes. Let me remove myself from here so you can actually see the charts better. You have to talk about where we're at in relationship to risk. And if we start to see the markets wobble a little bit, you're going to see some dollar strength, which, when you see the euro pivot like this off of resistance, you see the cable reverse off of resistance. Last week we talked about this descending channel, right, in the cable, and it actually rejected it. Remember, a lot of people are looking at this as a longer term range, but the top of the range being 124.50. Well, notice that we have a descending channel that's now really taking hold. This is something that we talked about last week. So if you were listening in last week in last week's week ahead video, you kind of knew that already. But also take a look at the Aussie dollar. This Aussie dollar is trading really heavy. We're below the 200-day moving average. And did you know that we have the RBA this week? Now, the RBA is one of the first central banks to say, hey, listen, we are going to, we're probably going to, be on pause. So depending on how Australia is starting to feel about, growth prospects around the globe, and remember, a commodity-based currency like the Australian dollar is very sensitive to growth. And so if the RBA is starting to really sense that there is going to be a global slowdown going into the second half, or maybe even the second 3 quarters of 2023, we could really see the Aussie come under pressure this week. We do have the RBA Tuesday morning. That'll be Monday night if you're in North America. So keep that in mind, because I'm going to say from a technical point of view, the Aussie dollar has not even been able to take out the 38% retracement. And when that fails to happen, that means that the chances are heightened for resumed interest to the downside, because if we can't even rally in a risk on environment, wait, did you say risk on? Yeah, we've been in a risk on environment. If you can't even get the Aussie to rally in a risk on environment, think about how nervous those longs are feeling that own the Aussie and say, oh my God, this thing isn't even moving when stocks are moving higher. What happens if stocks come down? So we're going to talk about the stock market. Let's go back to the S&P chart, and you can see we've actually adhered right to this channel. Now, you might say, well, Blake, that's just a channel and it's resistance, and resistance is meant to be broken, right? Resistance is meant to be broken. You see it, support's meant to be broke. So resistance, supposed to be, resistance can be broken as well. So we could argue that we're breaking out. But I want to show you a couple of charts really quick before you get all involved in the stock market breakout and like, oh, hey, stocks are really rallying here. Let's take a look around and just look at a few things. So let's start off with, let's go look at the NASDAQ 100 really fast, okay? Actually, I'll do it this way. Let me pull you down to the bottom here. Let's look at the NASDAQ 100. You go, oh, well, look, we got a breakout, right? Yeah, we got a nice horizontal breakout. This looks like a pretty bullish move. But let's see how far we are away, from resistance. I mean, I would venture to guess that resistance might be even a little further, but also keep in mind that we just came off the end of month and end of quarter flows. Why is that so important? Well, if I'm an institution and I'm underperforming the markets and we're getting to the end of quarter and I'm a fund or an institution and I'm not fully allocated, I need to be fully allocated going into the end of the quarter, because I don't want my investors to think that I'm just sitting on cash when everybody else is investing. The markets are rallying right now. So I need to be invested to show people that I'm invested. But once I'm done with that window dressing, what am I going to do at the beginning of the quarter, which happens to be on Monday? Think about what might happen Monday or Tuesday. So you got the NASDAQ that looks like it's breaking out. You got the Dow that's also rallying too. So you think, okay, well, everything looks great. Well, let me show you a couple other stocks really quick. Let's go over to FAANG. Let's take a look at the FAANG stocks really quick. Now, the FAANG stocks are at, and you might be saying, well, Blake, look, a breakout. Yes, but we're at the 38% long-term Fibonacci retracement of FAANG. That is a really big resistance that we're knocking our head into. Wouldn't it be something just to see the market try to break out and get everybody all bulled up, and then come early next week, we see a reversal because you start to see some profit taking or people go back into cash because they don't want that exposure? That's entirely possible. Let's take a look at Apple really quick. Just, inside of the FAANG stocks. Let's go to Apple and see. Whoops. That's where is it? There we go. I'm in indices. That's why I'm like, where's the stock? Okay, there it is. Okay, let's take a look at Apple. Apple is running its head right into a gnarly, I said gnarly, resistance. It's trendline resistance. You could argue that it might be up here, it might be up here, but let's take a look at some fib levels just from a retracement standpoint, and you go, oh, wait a second, I'm at a 78% retracement of the last entire drop lower, and I go, well, I've got a head and shoulder pattern, right? So I've got shoulder, head, shoulder, neckline. So there's so much further to go. I'd venture to guess that a lot of people are in that trade already, especially on this breakout and that retest of the neckline right there. And I venture to guess that people are going to start getting a little nervous as we're at the 78% retracement, and we're also up at a descending trend line. Now, there's one other stock that I was thinking about just as I was just getting ready to film. I'm going to pull up a stock named Restoration Hardware. Are you guys familiar with Restoration Hardware? Let me show you the website of Restoration Hardware, and I want to show you it because this is a really interesting company if you're not familiar with what they do. let's just look at some of the collections. Let's go into living. Let's go to what's in stock, and let's take a look at a sofa. So you have sofas here, and let's see, they range from, I don't know, 5,500, 7,000. Okay, continuing on. Let's go into, well, let's take a look at dining rooms. Let's go see that. So you got dining room. Let's say what's in stock. You got in dining room. You got tables. Let's go into the table collection. Come on, somebody show me something. I just want to go in stock. Okay, let's see in tables here. What's in stock? Oh, well, this table for $8,000 is in stock. Like I said, it's an interesting company because they sell the most high-end products out there. One of the biggest retailers that sells the most expensive stuff to the one percenters. When you're looking at a stock like this, you have to ask yourself, when you're in the trickle-down economy has been, big over the last 13 years. Why is that? Well, you provide all this liquidity to the markets, and it starts from top down. You got the 1%, they spend, they buy an $8,000 table, which, the salespeople then make some money. They might get some bonuses or a commission. And I'm not talking about Restoration Hardware. I'm talking about just generally speaking, or it's a Lamborghini or whatever. Salespeople make money. They spend more money at Target or Walmart, or they buy a new car, whatever the case may be. You get this trickle down economy. Well, when money is not trickling down, and you see companies like Restoration Hardware really struggle, and you see this like very bearish looking consolidation, and then you start looking at all the other stocks that I was just talking about, or the FAANG, or, where we're at in equities. You can probably take a look at, we just took a look at Apple. You look at things like that, and you have to start to be really careful with rallies in equities or in risk. Then you take a look at, let's just take a look at the VIX really quick. And you look at volatility, and volatility is near really critical support. When volatility is low, you want to be buying stocks. But when it's at support, the risks are that you start bouncing from these really key levels of support. And once that happens, then you're at risk of some risk aversion. Right? You're in higher volatility and stocks start to come in. And what is the biggest beneficiary of risk aversion? Well, there's a few of them. One of them tends to be the dollar. And if you look at the dollar index, the dollar is actually now starting to carve out let me get rid of me here. It's starting to carve out a higher low. If we get above that 50 DMA in the dollar index right there, I would not want to be short the dollar. Okay, so keep an eye on that 50 DMA as we go into next week. One of the other beneficiaries is gold, and what we've seen in gold is a nice bullish consolidation. I want to show you, just a little setup here. Now, I am in the camp that under certain circumstances you will see gold and the dollar rally at the same time, but that's got to be under extreme stress situations, whether it's a geopolitical risk. Let's say there's an attack of Taiwan from China. I'm just using that as an example. Or there's a bank run much bigger than just your regional banks. You might get some real risk aversion where people run into gold, they run into the dollar, they might run into bonds at the same time. But if we see the dollar rally and gold rally at the same time, that's usually a sense that you really got to be very careful. But gold, you can see, is holding up. And as long as it's above 1930, which is right here, I wouldn't be too bearish on gold. But if dollar takes off, gold could show a bit of a reversal. Now, have you seen silver yet? Let's take a look at silver. Silver is at really big triangle consolidation as far as I'm concerned. And so, when you got silver knocking its head up against resistance, you got gold just kind of struggling here. And if gold starts to break down, that would mean that the dollar is probably ready to break that 50 DMA. You guys with me thus far? Okay, there's another currency that is, could be viewed as a risk currency, and that would be the yen. Now the yen has had a nice bounce due to the fiscal year end. Like I said, one of my colleagues, Kay, he made mention of that this week, which saved my ass, to be honest. It's one of those things that I was very, very hesitant to get aggressively long the yen because of that. And if you were in the Forex analytics community, you knew this. If you listen into the shows every day, you're aware of that. And like I said, I didn't have the best week of trading for me. But what I didn't do is I didn't add to any losing trades that were offsides, because I knew it was the end of month, end of quarter, end of fiscal year. So you have to be really, really careful during those types of situations, because the market tends to be one way, and that's what we got this week. But now that we're past that, watch the yen here. The yen. Let's look a little bit closer detail here with the yen. Let me remove this fib, and let's talk about after we completed that bear flag pattern. You'll notice that the dollar yen has stalled ahead of the 50% retracement, and we're starting to come off again. And if we start breaking back below 132, that might be signaling that there's more yen strength to come. And when you get yen strength and you get dollar strength at the same time, that is a big development. I'm going to take you over to the 6J really quick. And the 6J is an important chart to me, because this is long-term how I feel about the yen. And I think the yen is forming a longer-term low. Now, why is it forming a longer-term low? Because you have a new Bank of Japan governor who's going to be coming in, taking the place of Kuroda this next month. Well, actually this month now. And, he has been very reluctant to reverse monetary policy for his, how many years? I think 12, 13-year tenure. I have to go back and look for sure. But with the new BOJ governor coming in and inflation starting to rear its ugly head, even in Japan, we might see a reversal of BOJ policy coming in this next month. And if that's the case, the yen could really stand to rally substantially moving forward. That's been my stance over the last month and a half, and I still am sticking to that. And longer term, this is the chart that I'm actually looking at. So that means that I am looking to sell dollar yen. I'm actually looking to sell euro yen. I'm actually short euro yen right now. But I'm not trying to speak my book. I'm just saying that is going to be the mode that I'm in until or unless I learn something otherwise, that Ueda is not going to is going to continue to pursue the current BOJ policy, which I don't think is going to be the case. Anyway, I want you to keep an eye on the 6J, because this is a very, very long term. This is a weekly chart. You can see this is 20 years worth of data that you're looking at right here. I'm looking at a big long-term reversal after a false breakdown after 20 years, right? So that's something that I'm paying really close attention to longer term. Now, one of the things that I want to make sure that I do mention to you guys and gals, it is the jobs report. We do have the jobs report on Friday. Friday is going to be a big day because not only is it the jobs report, but it's also going to be very low liquidity. You have so many people that are taking the weekend off, the long weekend for Easter, that you got a lot of bank holidays on Friday, but the jobs report is still going to come out. And when that jobs report comes out, the liquidity is going to be less. That means there's going to be higher probability for volatility. The market is looking for a jobs report that comes in around the 300 or 300,000 or 250,000 mark, excuse me. Those numbers are going to change, and the estimates will change throughout the course of the week as we get all the other data, whether it's the services, the ISM, the ADP jobs report this week. Those numbers are going to shift, so the forecast might shift. But still, what that really shows to us is that the jobs picture in the U.S. is still very vibrant and is very strong. And it's going to be hard for the Fed to reverse course of their tighter monetary policy while they have this the Achilles heel, which is a strong jobs report or strong jobs market, it's going to be really tough for inflation to continue to come down at a rapid rate. So therefore, the Fed's job is not done. And so if you get strong data or even a jobs number that's still above 200,000, if we create 200,000 jobs or created 200,000 jobs in March, that's going to keep the dollar in very much a strong position. And that should keep the stock market and risk in general very defensive. So keep that in mind as we go into later this week and expect volatility. So when you get volatility, how do you approach volatility? Well, you approach it with smaller positions, wider stops, so you can adjust for wilder swings. Now, I know some of you might be thinking opposite, but yeah, if you want to get yourself into really hot water in a very quick period of time, in a low liquidity environment when there's high volatility, step up your position size. You might, if you find yourself on the wrong side of that trade, that's one way to get yourself out of this business really quick. So, guys, gals, it's going to be a huge week this next week. You know, the best place to be all week is going to be with us in our live shows, whether it's the Flow Show, it's free, it's in European hours. Ryan Littlestone is out this week, but don't worry, Stelios is there, K-Man is there, and then the free Face shows where you're going to catch myself and the rest of the team there giving our analysis of the markets. Plus, Dale does such great interviews each and every day with some of the best names in the financial industry. So, and it's all free to you guys. So we'll see you there. My name is Blake. I hope you have a great remainder of your weekend. I'll see you Monday on the Face Show. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.